Welcome to Bullshift, the podcast. My name is John DeGuy. I'm the host of the podcast and the author of the book, Bullshift. This is the podcast where we talk about how behavioral finance might have an impact on your lives and how the financial services industry shifts your attention to make you feel more bullish. My guest this week is Greg Romundt. Greg is the founder and president of Centurion Asset Management, a company that manages over $7.2 billion in assets worldwide. Greg is highly acclaimed and has won a number of awards, and he has done his work with regard to asset management and real estate management throughout the world, including in Canada, Europe, and Singapore. So it's a great pleasure to have you on, Greg. Welcome.
Thank you so much. Happy to be here.
I always like to begin by asking my guests to talk about what they do on a day-to-day basis. Tell me about what you do as the president of Centurion, Greg.
I have done almost every role that there is in this company, except probably what the hardest job is, which is our customer-facing building managers. So the people who live in our buildings and change toilets. So I'm horribly incompetent when it comes to those kind of physical tasks. And my role has evolved really over the years. Today, really I focus on strategy and thinking about where we want to go, how we want to position, where I want to allocate the portfolio, the risks I want to take, don't want to take, and deal adjudication and relationships, right? So talking to advisors and other large investors and co-investors and stuff like that. So it changes.
One of the things I've always admired about you is that you are a relative to other people in the industry. You're more of a deep thinker, and you're widely read, and you think about various things. And I've read a couple of your white papers, and they're pretty fascinating. And I wanted to begin, therefore, by asking you to explain something that you wrote about a couple of years ago called the Cantillon Effect. I had never heard of it until I read about it in your white paper. And it seems as though the impact of the Cantillon effect on monetary policy is a very real concern in 2024. And yet it's one that most people like me, until I read your paper, had never even come across. Could you maybe take a moment to explain what that is?
Sure. So this was written about by a guy named Cantillon hundreds of years ago. And one of the things he identified was that when money gets printed, it benefits the people who get it first, and increasingly people further down the line as they get it less and less and less. But the people at the end of the line, all they end up is experiencing inflation. But the ones with first access make a lot of money. And certainly for, really since we went off the gold standard, this has been very much a case and is now kind of manifesting itself in the inflation we see everywhere and the super concentration of wealth at the top, and while everyone else is kind of getting pushed down. So that's very much, in a nutshell, what the Cantillon effect is.
And so thank you also for helping me to pronounce it properly. So it's Cantillon and not Cantillon. Yeah. The Cantillon effect, it seems, is something that happened writ large in the aftermath of COVID, because the printing presses got cranked up and money supply was increased almost exponentially. Yep. And there were fiscal impacts as well in terms of getting money in the form of CERB checks and that sort of thing. But perhaps you could explain how the Cantillon effect played out, in your opinion, over the past 4 years in the aftermath of the COVID crisis.
Okay, so there's a lot to unpack there. But, look, when we went into COVID and they just printed, $350 billion of excess cash to run a deficit and send money out, there were certain groups, you got $2,000 or whatever like that, but there were other groups that did a lot better than that. So who were the big recipients of this, right? I mean, really, grocery stores, because they were allowed to stay open. You got your $2,000 check, and you got to go spend it on groceries or in the big box. The simplest, example is the small businesses all got shut down, weren't allowed to be open because they were too risky. And the big businesses, the Amazons of the world. Like Amazon is probably the greatest example of the beneficiary of this. Is that business went elliptical because everyone went to shop from home, and that's an advantage they have not given up, even after COVID is in the rearview mirror.
And it's interesting because I looked it up just the other day. The price earnings ratio for Amazon as we start 2024 is 78. So when you start talking about how certain things might be a little bit overpriced as a result of getting access to the money on the front end, Amazon is an example in terms of the story fits, but also if you apply traditional economic metrics and valuations for securities, it certainly passes the smell test in that regard as well.
Yeah, I mean the Magnificent Seven are a fascinating case for what they did last year. And if we didn't have the whole Chat GPT kind of AGI kind of craze, I don't think we would have experienced the stock market rally that we did. Probably would have been a very different experience. I don't think we really have any sense. I mean, I don't have any Mag 7 exposure. Probably, maybe stupidly so. In 5 years, we'll look back. But yeah, very hard to say that there's value in that. But geez, what do I know? I'm not a stock guy.
Right. Okay, I wanted to talk to you also about a guy that I follow, and I think you're fairly familiar with it, and that's a guy named Nouriel Roubini.
Yeah.
And he had a book that came out almost a year and a half ago in late 2022 called Mega Threats. And in the book, he enunciates 10 different things that are macro level major threats
Yeah.
to the global economy, the global world order, and stock markets, I suppose, in particular. And these are things that are systemic, that are not going to go away anytime soon, and that are baked into the system.
Mhm.
I'm wondering if you could maybe offer your thoughts on what Roubini has said and the so-called Roubini cascade when things intertwine and how one thing will have an impact on the other and the systems theory of various mega threats interacting with one another.
So, I mean, this is one of the things I've written about as well. Is that you know first thing that happened really with COVID is the monetary policy was sacrificed to the political gods, right? So this set off a bit of an inflationary storm. But what was followed by, you look at things like what's happening in Ukraine and Russia. So this set off another geopolitical wave. For example, that I believe in the West, not necessarily the US, but the rest of the West, so Canada and Western Europe, have dramatically underinvested in weaponry and our mutual defense. So, Canada runs 0.9, our commitments to do much larger than that. If you think about that, well, we'd assumed that this peace dividend post the collapse of the Soviet Union would, continue to pay dividends forever. But now we didn't invest in our defense, or our armed forces are not only undermanned but underarmed. They're old and under-teched. So this requires a tremendous amount of investment. I kind of did a back of the envelope and I said, well, look, if we've underinvested 1% per year for 30 years and we need to spend to get back to 2, and we need to catch up, and we need to do that over 10 years. So, let's call that, 3% of GDP for the next decade. So where does that money come from? That's a tremendous amount of money that needs to get printed out of nowhere. And that by itself is inflation. The next thing we saw was what happened in China. So we quickly understood that China was not our friend in exporting COVID and covering it up and grabbing all the global medical supplies. And then we realized, um, I think certain people realized this earlier, but it became, I think, much more well understood that globalism and globalization poses risks. When there's a global crisis, you don't have capability to make your own medicines, medical supplies, supply cars, batteries, all these other things that we need on a day-to-day basis, let alone chips that make everything function. So I believe that the peace dividend is not only in reverse, but also the globalization, which has allowed us 40 years of disinflationary trends, and it has to go into reverse. Because do we want to rely on there being another country is in charge of our own prosperity and our physical and security? So this is another trend deeply against us. Then you look at things like what the U.S. did in response to Ukraine and Russia, which was to seize Russia's reserves, and so now they've weaponized the dollar, and this again is going to be inflationary as you've seen a strengthening of the BRICS, and the BRICS are saying, well, like the dollar's not going to get replaced overnight; it's too important, but slowly, it would be irrational if you're ever worried that the US is going to do this to you, that you would be, willing to risk all your liquidity saving in US dollars. So again, you take all these kind of little things put together and they are pro-inflationary and will feed on themselves. Add in that we've got an aging population, which in itself means, well, who's going to be the labor? And we saw the labor markets really challenging over the last couple of years. We've tried to hire people, and they're less available, harder to get into the office. Harder to get into the office is a real thing. So productivity is an issue. Like everything's going in the wrong direction all at once, and that's going to make navigating the next decade to be quite challenging when all of these things kind of fit together.
And if you think of the knock-on effects, Cold Wars becoming hot wars being inflationary not only because of supply chains, but also because of defense spending. Defense spending cranks up your debt levels. Debt levels means the cost of carry is more of a problem. It's more inflationary, so you can't lower inflation because you've got to keep rates high to keep inflation under control. And one problem builds on the other, and it sort of cascades upward. And it's the sort of thing where in the
Yeah,
past we had 30 years from the early 80s until the early 2010s, up until the global financial crisis, where interest rates were disinflationary, where rates were coming down, and we had a tailwind. Well, now we have a headwind. There's no question that rates, although they may not stay as high as they are presently for more than a few quarters, when they come down, the new normal will still be substantially higher than it has been for pretty much all of the past decade. And we have a whole maybe generation or two generations of investors that have never known what it's like to invest in a high or even a moderately high rate environment. They've always been in an environment where even if rates started high in the 80s, the trend was downward, and they could benefit from the disinflationary impact of having rates go from 12 to 11 and from 11 till 10. But going from 5.5 to 5 and then staying there is not really going to do you a whole lot of good when you've got debt levels that are incredible. The U.S. is at $34 trillion in debt right now.
yeah,
It's astonishing.
it's astonishing, and in my ratings, I've talked about why I think interest rates at these levels are not sustainable. And, one of the reasons is because of the level of government debts and the amount of spending that needs to be made to address these. We didn't even talk about the green revolution, which governments still seem to be wanting to invest in. And if I've seen various studies which suggest if we need to spend, you know, 30% of GDP over 10 years to get to their green objectives, that's 3% inflation per year on top of all these other effects. But let's just, say we need a lot of money.
Yeah.
So where does this money come from? Well, and certainly in the Canadian and the US context, we're already overtaxed. Don't tell that to Olivia Chow because she seems to think otherwise. But so I think the only place it's going to come from is the printer. And if we look back in history, the last time we were here in terms of debt to GDP was post World War II. Now we just finished fighting a war, not starting one. And the Fed pegged long-term bond rates, like 10-year bond rates, at 2. when inflation was 8 to 12. Um, so I think that that's where we're going because it's just going to be financial repression because there's no other way out.
Yeah.
They have to inflate their way out. They can't get it from tax revenue. They can't get it from growth. Uh, so that's the path that I see.
The concern that I have and that I've written about in Bullshift, and I'm wondering if you could weigh in, is that the impact of that is that people's expectations for returns need to be muted. We've done well because we've had those tailwinds supporting us and aiding and abetting our returns for a generation or maybe even closer to two generations. And those good times, we talked about the cancellation of the peace dividend 2 years ago, and now all of the renormalization of rates, which started about 2 years ago. My view is that somewhere around the beginning of 2022, the world changed, and people are still thinking that the world that they lived in for the previous 35 or 40 years is the world that they will experience for the next 35 or 40 years. And brother, that just ain't going to happen. And I'm wondering if you can think about, you could offer your thoughts about what typical investors are expecting currently in your impression, what your thoughts are, what you think they're expecting, and maybe if you could weigh in on what you think they ought to be expecting instead.
So, I think I saw some survey that said investors are expecting forward-looking returns of around an average of 10%, give or take, right? Depending on the survey.
Is that
Now,
on a balanced portfolio or on an equity portfolio, or just on equity?
well, I think it was in reference to stocks. But I think a lot of investors, or when they ask these questions, people just assume that portfolio equals stocks. I don't think that that's possible, in a normal balanced portfolio, unless you're an amazing stock picker. And quite frankly, I don't believe that that's actually possible. Um, you know, but that's a whole other discussion. So the challenge is, like, if you look, I'm a big follower of like Schiller's work, and if you look at the Cape 10 ratio, where we're trading, I haven't pulled it up today, but we're in the 30s. Um, you know, it's not a predictor of buy and sell points, but it's a fairly decent predictor of forward-looking 10-year returns. So I think we would be doing well to get those kind of mid-single
I can
digit.
help you, Greg. I can help you. I checked just this week, and the CAPE, the cyclically adjusted price earnings ratio on the S&P 500 is around 32
Yeah,
presently. And
yeah,
historically, when the CAPE is at around 32, the return for the ensuing decade is around zero.
yeah,
Zero.
yeah.
So
I mean, like there's a number of things when you look at like the Mag 7 and you compare it to like the Nifty 50s and the bubble and percentage of market capitalization and total market capitalization, it looks pretty frothy.
yeah.
So yeah, no, I'd be worried about forward-looking stock returns as well. But it's also extraordinarily difficult when you have so many macro headwinds for stocks to do well. Like, could the Middle East crisis spiral out of control? It could. And, could you see oil all of a sudden at $200? Yeah, you could. And that would be a disaster. Could we see conflict in, China over Taiwan? Yeah, we could, right? The prospects of global war are probably higher than at any time in my lifetime. So
Maybe with the exception of the Bay of Pigs crisis, although I don't know how old you are, you might not have been around for that. So
I wasn't alive just yet.
yeah, okay.
But like the reality is, like, it's you know there's a lot of these risks out there, and we just don't know how, and assets are still kind of priced to perfection, so
Right.
nothing's really cheap. So I'm not necessarily optimistic on a general financial markets basis. Like certain sectors, I think will do well. Like I think our business will do well, but to get, you know, it's going to be a challenging decade, given everything that we've got to
Right.
face.
The other thing that I wanted to talk to you about is a book that came out about 35 or 40 years ago called The Fourth Turning by Strauss and Howe.
Yep.
Neil Howe came out with a new book last year, I think called The Fourth Turning is Here.
Yep. I read it.
I haven't read the new one. I am moderately familiar with the original, but I'm pretty sure that you're familiar with it, and I'm wondering if you could weigh in on what your thoughts are with regard to these trends that tend to repeat over 20-year cycles, and the various archetypes and the secula and the things that are part and parcel with the book, and how that might overlay with macro investing in 2024.
So, yeah, I'm familiar with both books. I recently read his newest book, which really, if you haven't read the first one, you can probably go straight to the second one. It's up to date. I would say, looking back at that book, and you can kind of see when it was written that you would have gone, it's really future casting, but boy, did he get a lot of stuff right. And so let me boil it down. And essentially, the authors argue that humanity and human civilization runs in cycles roughly corresponding to a long human lifespan of around 85 years, 80 to 85 years. And there's four cycles inside of this long-term cycle. And each roughly corresponds to a generation. So I'm a generation, my kids would be one, then their kids would be another one. And how these, you get this rise and fall in these generations, and why? Why do you go through these cycles? Because essentially, and it's quite logical, that the lessons of your grandfathers are lost on the youth. And I think some of the best examples of this are, last really large global conflict was almost 80 years ago, in World War II. And certainly, I try to stay away from social media as much as possible, but the number of people that are screaming for war, and wanting to participate in the Russia-Ukraine conflict. I just think, are you people nuts? Do you not remember, World War II? And like, I wasn't here, but at least I'm an avid reader of history, and World War One before it. And these conflicts start over things that seemingly are less serious than what's going on today. So anyway, I do tend to believe that um, human civilization kind of run in these cycles. It's a great book. I would recommend anyone who's interested in history, financial markets, or even what's happening in the news. You can see the same themes playing out, not only global geopolitics, but also what's happening in our own domestic politics. How politically, whether you're talking about Canada, the US, or anywhere in Europe, you've got this left and right where they can't even talk to one another anymore.
Can't even
Um,
agree on basic facts.
yeah, can't even agree on basic facts. Exactly right. So these are dangerous times, and they tend to correspond with um, the fourth turning, which is when society tears itself apart before hopefully in the first turning itself around. So,
And my recollection is that the fourth turning, or that everything comes to a head with a crisis somewhere in the next, 5 or so years. And if you think about it, the American Revolution took place in 1776, and then
yeah,
approximately 80 years later, the Americans had a civil war, and approximately 80 years later, the Americans were in World War II, and approximately 80 years later that's about 2024, 2025. And,
yeah,
there are a lot of people who think that uh, not only the likelihood of what's going on in Ukraine becoming a larger war, not only the likelihood of what's going on in Gaza becoming a larger war that extends, especially if Hezbollah starts making the Israelis annoyed from the other border. But now we have the likelihood of, I think, a very real likelihood of an American civil war, because we have, one party's presumptive candidate that will likely deny the results as he did 3 years ago. And if he loses, he'll just say, "Well, I won," and his supporters will come out with guns ablazing, and we'll see. And I don't want to sound like Handmaid's Tale all over again, but it's the sort of thing that is certainly plausible, and I don't think markets are really giving enough thought to how this could play out. I'm not saying it will, but it certainly could, and I don't hear enough people talking about it.
No, I mean it's really quite amazing. You've got a number of states that are trying to ban Trump
Yeah,
from the ballot, and litigate him into submission. Boy, like, no matter what you think of the guy, that is bad political precedent. When
yeah,
because
right.
if he wins,
Hmm.
what you do to your enemy in the political system called democracy, you can expect they're going to do to you when they're in charge. So, what I would call the rules of polite play have been completely thrown out. But you can see that not just in U.S. Canadian domestic politics, you see it geopolitically. Um, so and all these things are quite dangerous. Now you layer on top inflationary problems. You layer on top a historic debt super bubble.
Hmm.
Um, and how have governments historically solved debt super bubbles? This is not the first one, right?
Yeah, right.
These have been around for thousands of years, and ultimately they get solved with a combination of war and inflation, right?
Right.
Because
And
at
Ray
least
Ray
when you have
Dalio talks about a lot of that. Yeah, and in his book, Principles for a Changing World Order. Yeah, he talks about how, again, these are things that have happened before with the Dutch, and then the British, the Americans, and
yeah,
now China's on the ascendancy, and so here we are all over again. It's amazing how history doesn't repeat itself, but it rhymes, and a lot of people don't. Yeah.
I
So, all
mean,
right. Well, that's a really cheerful thing to talk about, Greg. But we had to cover this ground. But I think it's important. I wanted to have you on as a guest because a lot of people, the industry is inherently optimistic, and I consider myself to be an optimist. I presume you think of yourself as being an optimist as well.
I
But
do.
you need to be realistic too. And I think there are a lot of things that are a realistic reading of how things are evolving, and a realistic reading of history will cause you to temper your expectations if you're looking at it, with a clear head, and really trying to get a sense of what's happening, as opposed to what the wishful thinking of what you would like to have happen. And that's a really important distinction. I like to end everything with two segments. The first is something that I call "That's Bullshit."
Yeah.
What thing would you point to in the financial services industry that could be done differently, that could be done better?
What could be done better? I would say the burden of regulation has gone too far. I can tell you, it's not anti-regulation. I think you need some regulation, but I think the amount of time we and money that we have to spend on compliance is becoming exceptionally challenging, and it's a cost burden. And it's not. This isn't just limited to financial services. I think this is all parts of our site of our society. And I'll relate this to my industry, like housing. So in Canada, it takes 100 months to manufacture an apartment building or a condominium. In the U.S., it takes 24 months, and this is largely because of excess regulations, right?
Right.
So yeah, I would say excess regulation.
That then brings us to the second half, which is shift happens. How I understand that you would reduce regulation. Can you be as specific as you can? What would you do to get rid of the red tape, to make it to streamline the process, to get things moving a little more quickly?
Well, can I speak specifically to my industry? Because I think
Sure.
that's
Yeah.
where I would have the most value. Um, Look, one of the challenges everyone says we have in Canada, and I've been pounding the table on this for years, is we've got this housing crisis. Now everyone talks about it, right? So, what do we need to do differently? Number one, we can't have 1,600,000 people arriving per year, the fastest rate of growth of population of any country in the world. We can't have that much. We need if we want long-term immigration in those levels, we first need to get our ability to handle our infrastructure. We need doctors and nurses. Everyone wants, when they come here, guess what? They're going to want doctors and nurses, and they're going to want to send their kids to school, and they're going to want a house. All reasonable requests, none of which we can offer. So we need to fix that. The second thing is we need to reduce the red tape, as I said. So what would I do? One of the things I've been calling around for a while is, it's always amazed me that when you want to build an apartment building and you have to go and get the design and the zoning, and every building that's in Canada is basically you're paying for a new design every single time and a new approval every single time. And as of right zoning, so you say these neighborhoods, and let's say just take Toronto, say everything that's on the young corridor, and you pick your corridor, anything within 500 meters, you can put up 30 stories, provided it's not, interfering with the subway, or, you come up with some rules. And, design 20 designs approved by CMHC that says, if you build one of these designs and you fit you can go. That would be the easiest change we could make, right? Because you need to get the municipalities completely out of the process, because they really don't contribute anything, in my opinion, right? So those would be the two quickest changes that I would say are entirely realistic, that could be done. Now, will that happen? No, it's not going to happen.
Right. All right, Greg, thank you so much. It's always a pleasure speaking with you. You are really one of the most thoughtful people I know in the financial services industry. And I love the fact that you are prepared to think out of the box and are a student of history. It's really refreshing. And I want to thank you for taking the time to join me today.
It's my pleasure. Thanks so much.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.